If you clicked on this video, you're probably curious about what it takes to join the wealthiest 1%, and the answer to that depends on where in the world you reside. I've been part of private banking for about 3 years previously, and then I dealt with high net worth individuals. That was people with 3 million Swedish kronor or more in assets. However, today we're taking a look at a whole different ballgame. We're taking a look at the ultra high net worth individuals. Alright, so to present some research for you today, I used the Knight Frank wealth sizing model and used research presented by them in their yearly report. So first of all, let's take a look at the list, go over it briefly to see what it actually takes in the form of numbers. And then we will look at some trends as well later on in this video. So if you just want to hear the list, stick around in the beginning, and if you also want to hear the trends that are growing wealth, well then you can watch the rest of the video as well. Alright, so to join the 1% in Monaco, you need $7.9 million US. That's the wealthiest nation currently. Then in the US we have $4.4 million needed to join the 1%. That's the majority of where my viewers are from, so now you know what it takes to join the 1% in your country. If we look further down to Europe, we can see France, Germany and UK being about the same, with France at $2.1 million US needed and UK $1.8 million needed. And if we move down the list to South American nations, we can see Argentina with $360,000 needed and Brazil with $280,000 needed to join the wealthiest 1%. And on the bottom of the list we find Kenya, where you need $20,000 to join the wealthiest 1% in the nation. You can pause the video if you want to look at some specific country, and you can look at the Knight Frank wealth sizing model online if you want to find your specific countries, if your country is not part of the picture that I used here in the PowerPoint model. Alright, so when it comes to worries and opportunities for the ultra wealthy, we can see that those two correlate heavily. For example, wealth transfer to the next generation, both an opportunity and a worry for many wealthy people. And we can see with COVID high on the list on 80%, and for example tax issues being both a worry and an opportunity. With that being said, let's move on to the trends that are driving wealth today. So I have summarized the key findings in the report that I used in this video, so that you don't have to read the whole thing. So let me just go over the key points with you today. Alright, point number 1, the global response to the pandemic supported the wealthy. With lower interest rates and more fiscal stimulus, asset prices have surged, this is the stock market, driving the world's ultra high net worth individual population 2.5% higher over the past 12 months to more than 520,000 individuals. The process was seen across North America, Europe, but Asia was the main growth driver with 12%. And we saw a real upswing there. The expansion in wealth was not universal, with a fall in the number of wealthy people in Latin America, Russia and the Middle East, as currency shifts and the pandemic undermined those local economies. So Asia is key to the wealth story. We can see this in the prices of luxury goods being driven by Asian consumption as well. But the US is and will retain the world's dominant wealth hub over our forecasted period, but Asia will see the fastest growth in ultra high net worth individuals over the next 5 years, at 39% compared with the 27% global average. And by 2025, Asia will host 24% of the wealthy individuals, up from 17% a decade earlier. The region is already home to more billionaires than any other, 36% of the global total. The Chinese mainland is the key to this phenomenon, with 246% forecast growth in the very wealthy residents in the decade to 2025. And inequality will fuel risks to the wealth accumulation. So this is the political aspect, with some nations presenting certain wealth taxes. We can see this being proposed in Argentina, Canada, and South Korea, and it's likely that other nations will follow suit and try to implement special forms of wealth taxes to basically reduce inequality. You saw this as a worry and opportunity for the ultra high net worth individuals earlier in this PowerPoint. The world will be less global. Unsurprisingly, our survey confirms international travel will remain weak, with 84% of respondents expecting to continue to travel less this year. Meetings are done by Zoom now, not as much travel. Where this trend could become more entrenched in the notable drop in demand for international education that our survey reveals. However, with 11% of Asian ultra high net worth individual house purchases expected to be driven by educational motives, we may see a rise in permanent family relocations to education hubs, with London the main target. But the wealthy still want options. Despite the reduced desire to travel, nearly a quarter of wealthy people are planning to apply for a second passport or citizenship, a remarkable 50% growth in a year. As we note, there is a growing tension between rising transparency concerns over citizenship by investment schemes and a need to plug gaps in government finances through these schemes. And long live the city! Now we move into the residential part of the trend. And as urban guru Professor Saskia Sassen explains, history shows us that cities rise and fall, but always rise again. The pandemic, far from undermining the city, has shown the potential for rebirth. Expect to hear more about the 15-minute city, green cities, place making, and the coming redevelopment boom. No wonder then that the development land is the third most popular property in investment pick this year for the ultra high net worth individuals. Our city leaders in 2021 for wealth, investment, business, heft and innovation are London and New York, and for well-being you can find those in Helsinki and Madrid. And house prices, a major driver in global wealth, are rising because of the pandemic, not despite it. Our assessment of the world's leading prime residential market confirms that the average price growth accelerated over the past 12 months. While Auckland led the pack with a 18% uptick, reflecting New Zealand's sure-footed handling of COVID-19, even those markets hard hit by the pandemic are seeing growth. Low mortgage rates, a search for space, privacy, and changing commuting patterns are helping push prices higher. The pandemic-induced residential mini-boom will continue throughout 2021. So this is from an attitude survey that reveals that 26% of the very wealthy are planning to buy a new home in 2021, with the biggest driver the desire to upgrade main residencies. The survey points to a growth in demand for rural and coastal properties with access to open space, the most highly desired feature. The pandemic is supercharging demand for locations that offer a surfeit of wellness, think mountains, lakes, coastal hotspots, and demand will help fuel a price rise of up to 70% for the key markets this year. Expect more private investment in property. Despite overall property investment volumes falling in 2020, the capital deployed by private investors was still 9% above the 10-year average, for far stronger than the 6% fall in the amount committed by institutional investors. This theme will continue through 2021, with the quarter of ultra high net worth individuals planning to invest this year. In addition to development land, residential investments and logistics will lead requirements. And the pandemic is driving real estate innovation. The ubiquity of Amazon and Zoom has confirmed that the ability of tech to concentrate wealth. However, The attitude survey confirms that tech disruption is viewed as a key post-pandemic area for investment, driving demand in the still embryonic data center market and the burgeoning life sciences sector. Spurred by the pandemic, life sciences tech and advanced data analytics are creating new opportunities for rethinking office spaces in the key markets, with 43% of investors more interested in environmental, social, and governance focused investments than 12 months ago. Expect rapid growth in demand for green and energy efficient buildings. Alright, finally, with regards to investment in luxury items. So despite logistical challenges, investors continued to drive values higher for key collectible assets over the past year, led by handbags, a rise by 17%, fine wine had a rise of 13%, and classical cars had a rise of about 6%. However, as a shift to private sales, as auctions were put on hold, saw the art market stutter and values decline, with disruption to these most global of markets likely to continue through the first half of 2021. It is the second half of the year when investors will likely see the longer term direction for investment performance. So to summarize the trends, we have some property thinking, believing in big cities and green projects. For investment, the ultra high net worth individuals believe in technology and life sciences. We can see that those are a hot sector right now as well, with some of the technology companies having had tremendous returns this year. And also for luxury investments, this is a trend that we can see if we look at statistics. The value of very luxury items go up far quicker than the sort of standard consumer basket index. So inflation, you can say, in luxury goods is going through the roof, and we can see the growth in wealth in Asia as a key driver here, with luxury items being coveted in Asia having the highest gains. Alright, so those were the trends, those were the numbers needed to be a part of the 1%. Thank you very much for tuning in. I hope you make a lot of money in 2021. Goodbye, friends.